Hey, what's up guys? Welcome back to the channel and I hope you're all doing well. A tax-free savings account comes with numerous benefits such as tax-sheltered growth, tax-free withdrawals, and a savings flexibility that's really hard to beat. But there are many pitfalls that you need to be aware of before you start using your TFSA. And taking full advantage of your TFSA isn't all that simple. Like many Canadians, you can be making mistakes that are costing you money in either terms of penalties or unnecessary taxes, or causing you to miss growth opportunities to grow your wealth tax-free. In this video, I'm going to cover the biggest mistakes to avoid when dealing with your TFSA. Everything from overcontributions to day trading. So make sure you watch the entire video so you can take full benefit of your TFSA. Let's jump right in. The CRA keeps track of every single penny moving in and out of your TFSA, and overcontributing is one of the most common errors people make when it comes to the TFSA. If you accidentally contribute more than your allowable limit, expect a written notice from the CRA. This is known as an excess amount letter. This provides information about the TFSA rules and what actions you need to take in order to resolve your issues. You could be penalized with a tax penalty of 1% per month based on your excess contribution, and you will be charged this penalty until that excess amount is withdrawn. So for example, let's say you've overcontributed $10,000 for a period of 12 months. You'll be charged 1% per month, meaning you'll be charged over that 12-month period a $1,200 tax penalty. Now you can have this penalty reviewed by the CRA and have it potentially waived or canceled, but this process is not free of any hassles. And if you find yourself in a position where you have overcontributed and want to minimize your penalties, here's what you should do. 1, which is one of the most common routes, is that you must withdraw the excess funds from your TFSA. Now that may involve selling your stocks or ETFs so you have enough cash available to take back an excess contribution. Or the other thing you can do is wait for enough contribution room to be created, either waiting till next year or the future years until you have enough contribution room to absorb that excess contribution. Your contribution room increases every calendar year on January the 1st. My advice, if you have a large overcontribution, withdraw that amount right away instead of waiting for your contribution room to grow automatically. Now let's take a look at the ways in which you can actually over-contribute to your TFSA. First, you can simply put way too much money into your account. And how much is too much money? Well, that really depends on how actively you've contributed to your TFSA. If you were at least 18 years of age in 2009 but had never had a TFSA until now, your contribution room to date would be $75,500. This amount being as of 2021. And if you had maxed out your contribution room every year since inception, your contribution room would be $6,000 for the year of 2021. The most frequent cause of overcontribution stems from the fact that people misunderstand how withdrawals from a TFSA actually work. When you withdraw funds and you recontribute or replenish those same funds in that very same calendar year, it is considered to be a fresh deposit eating up your contribution room. Let's say as an example, you contribute $5,000 to your TFSA in 2021. You then decide to withdraw that same $5,000 in 2021. And then later you decide, you know what, I'm going to put that $5,000 back into my TFSA in 2021. So that means you've contributed $5,000 twice. That's $10,000 worth of contribution room you've used up in 2021. And this misunderstanding is a second most common form of overcontribution. So to summarize, do not overcontribute to your TFSA. I cannot emphasize this enough. The CRA does not look well upon those who knowingly bend and try to take advantage of the TFSA rules. Say for instance, you intentionally overcontribute with a view to generate a higher return than that cost of that 1% per month penalty. The rules allow the CRA to impose an even harsher penalty of 100% tax on the benefit, also known as your income, attributable to the overcontribution. Meaning, whatever money you make based on the overcontribution will be subject to 100% tax. You may be in a position where you have multiple TFSAs spread across multiple financial institutions. Now that's not a bad thing, but if you withdraw money from one just to put it into another institution, be aware that counts as a TFSA contribution. Yes, withdrawals do increase your TFSA contribution limit, but not until the following calendar year on Jan 1. If you're taking money from one TFSA in one institution just to put it into another institution in the same year, you could technically be over contributing. If you ever need to move money between financial institutions with regards to your TFSA, ask for a direct transfer. It won't count as a TFSA withdrawal, nor will it impact your contribution room. It also might make sense to consolidate your TFSA holdings with just one institution to simplify your life. It just makes financial planning and investment management easier. Now, regardless of where your TFSA is or with how many institutions it's with. You need to actually track your own TFSA contribution room yourself. You cannot rely on the CRA to do it for you. You need to keep track of what you're depositing, what you're withdrawing, and what your overall contribution room and limits are. Your information on file with the CRA may not be up to date based on your recent contributions, and its accuracy also depends on how soon your financial institution reports that information by year end to the CRA. There could potentially be a lag between what the CRA has and what you've actually contributed and withdrawn from your TFSA. So that's why it's critical to track the information yourself. My advice to you is keep track of your own records and be confident that you're contributing the right amount. And what's the best way to keep track of your TFSA? I have built my very own custom Excel-based spreadsheet for investors just like you that keeps track of what's going in and out of your TFSA. It also keeps track of your gains, your losses, your dividend income, essentially all the activity you could think of. I've made the spreadsheet available for you to download, so check out the link in the description of this video to get yourself a copy today. Now, what happens with your TFSA if you're outside of Canada? Generally speaking, it's okay to maintain your investments inside your TFSA in Canada if you end up living, working, or studying abroad. Having said that, you need to be aware that any new contributions made while you are considered a non-resident may be subject to a tax penalty of 1% per month. And if you withdraw money from your TFSA while living abroad, there is no tax in Canada, but you may be subject to foreign taxation based on the country you're living in. You also need to note that any amount withdrawn from your TFSA while you're a non-resident will be added back as future contribution room the following year, but will not be available to you until you re-establish Canadian residency. TFSAs are no doubt amazing. They allow for a wide range of qualified investments, but there are some general restrictions you do need to be aware of. For instance, prohibited investments include any property that you are closely connected to. For example, shares of a company or a partnership where you have significant interest, which could be 10% or more. This can trigger not one, but two special taxes, 50% on the value of the investment and 100% on any income or gains derived from the investment. The issuer of your TFSA must take reasonable care that your TFSA does not include any unqualified investments. But as an investor, you need to exercise caution and closely monitor your TFSA and know all the rules around the TFSA. And that's why I highly recommend make sure you watch my other TFSA video to understand all the ins and outs and all the rules that are not covered in this video. Securities that are not traded on a recognized stock exchange also run the risk of being unqualified from your TFSA. That's important to know as an investor who may seek investments out there on off-the-radar companies. My recommendation, consider holding more of your speculative plays outside a tax-sheltered account, where you can claim losses, should you have any, and still enjoy preferential tax treatment on capital gains. No matter what you're saving for, whether it's that special vacation, a new home, or even retirement, using your tax-free savings account is a smart choice in reaching your goals. And when you avoid the common mistakes listed in this videos that can really hurt you, you'll get to your goals that much sooner. And if you're new to the channel or you've seen my content before, do me a huge favor, hit that like, subscribe, or thanks button, because it lets me know to produce more content like this and you don't miss out on future videos. Although TFSAs and RRSPs are both tax shelters, that doesn't mean they treat all investment income the same way. An RRSP is considered to be a retirement savings plan under the Income Tax Act. This means if you receive dividends in your RRSP registered in companies that have a tax treaty with Canada, such as the US, that income is free from any withholding tax, which is typically assessed by foreign jurisdictions on Canadian investors. That's actually good news, especially if you hold foreign investments as part of a balanced portfolio. It's always my recommendation on this channel to make sure you have exposure to more than just the Canadian economy as part of your portfolio. A TFSA, on the other hand, does not share the same exempt status as the RRSP, leaving foreign dividends paid into a TFSA subject to foreign withholding tax. A non-registered account is typically a better choice for foreign dividend paying investments because you can claim a foreign dividend tax credit to offset any withholding tax. In a TFSA, these taxes are not recoverable. Now, despite the name, it's better not to think of your TFSA as a savings account. To enjoy the tax savings that come with a TFSA, your investments need to have meaningful growth potential. If you're using a TFSA to hold cash or as a high interest savings account or other low risk, low growth investments, you're actually giving up the main benefit that comes with a TFSA. Instead of thinking of your TFSA as a savings account, think of your TFSA as a tax-free investment account. Consider adding stocks, consider adding ETFs to your TFSA. And if you don't know where to start, I have an entire series dedicated to some of the very best stocks and ETFs for your TFSA so you can take full advantage of that tax-sheltered growth. Growth that you simply won't find in just a high interest savings account? Now, this is a topic I've been meaning to talk about for a while now because I get asked this all the time. Day trading, is it possible? Can you day trade within a TFSA? The purpose of a TFSA is to help Canadians save for both short-term and long-term goals. Your balance accumulates faster in TFSA because money growth is tax-free. It also means that interest, gains, dividends are all tax exempt within your TFSA. You can withdraw any amount you like at any time without incurring a penalty. Now, having said all those wonderful things about a TFSA, the CRA prohibits a user from carrying on a business from within a TFSA. So that means day traders, beware. High frequency trading does raise alarm bells. The CRA conducts random audits to catch anyone abusing the account and making quick profits by buying and selling stocks. Once the CRA suspects you of generating business income, not investment income, your account gets flagged. The CRA will stop you in your tracks and charge heavy penalties if you're found guilty. There is a very fine balance that you need to maintain when it comes to your TFSA. It's perfectly okay to build and manage your investment portfolio through a self-directed TFSA, but you need to be aware that high frequency trading or aggressive day trading may draw the attention of the CRA auditors, and you do not want to be in that position. If the TFSA account is determined to be carrying on a business, all gains could end up being taxed as business income, which is different than investment income. And when determining whether the TFSA should be subject to tax or not, the CRA does use several factors. It's not just one thing. The CRA uses various factors to make that determination whether your account is carrying on a business or not. And here are some of those factors: the frequency of your trades, the quantity of securities traded, the time spent on trading, and your intention to hold the investments and resell them for a profit. This is not meant to be an exhaustive list, but just to give you a general idea of what factors that they're looking at. Do not try your luck or risk the scrutiny of the CRA. Some rule breakers who have been caught have actually been brought to court. If you're dreaming of quitting your day job and becoming a full-time day trader, make sure you consult with a tax professional first. If you hold stocks in your TFSA and are worried that your buying and selling of stocks would be considered day trading and be taxable as a business, my recommendation to you, definitely consult with a tax expert or a securities lawyer. Thank you so much for watching. Be sure to check out the links in the description of this video, and I'll talk to you in the comment section.